Welcome back, investors, to Ticker Time News. I'm Adam, and it's no April Fool's joke that the S&P 500 increased 0.3% on Friday, kicking off the second quarter on a positive note, despite a more inverted yield curve that we'll talk about in just a moment. Now, the Nasdaq gained 0.3%. The Dow Jones was up 0.4%, while these small caps really kicked it in and outperformed all the other big boys. The Russell 2000 gained 1%. Now, 8 of the 11 S&P 500 sectors closed higher today, the complete opposite in flip from yesterday, which was led by real estate up 2%, utilities 1.5%, and consumer discretionaries 1.3%, materials 1.1%. But technology down 0.2%, financials down 0.2%, and industrials down 0.7%, underperformed in negative territory. Now, the tech sector was pressured by valuation concerns again, as the 10-year rose 5 basis points to 2.38%. We can see that here, US 10Y on the stock chart, and you can see the 10-year yield here. It increased, and it's at 2.38%. Now, the financial sector was pressured by an inversion in the 210 spread, as the 2-year, and we can type that one in, US 02, can't forget that 0, Y, and that gives you the 2-year yield. That's up to 2.46%. Yeah, the yield curve right now is inverted. How long will it stay inverted, right? That is the puzzling question on everyone's mind, because we all know, we've seen the headlines, this is the big predictor on whether or not a recession is around the bend. Okay, now the industrial sector, it was pressured by weakness in transportation components. The Dow Jones transportation average, it dropped 4.7%. Treasury yields, they pushed higher in the wake of the March employment report, which showed decent job growth and a lower unemployment rate, plus continued wage inflation. And it's a receipt for the Fed to hike rates by 50 basis points next month. So all the data that we got today, all the economic data this whole week and today, is showing that the Fed is going to become more hawkish. And when the Fed becomes more hawkish, what does that do to the market? What do the markets do when the Fed becomes more hawkish? Let me know in the comments below what you think. Answer that question. What do markets do when the Fed becomes more hawkish? And I'll tell you at the end of this video. More specifically, non-farm payrolls increased by 431,000 on top of an upwardly revised 750,000 in February. Now, the unemployment rate, it improved to 3.6%, and that was from 3.8% in February. Now, average hourly earnings rose 0.4%, just as expected. Transportation stocks were weak, supposedly because the employment report also showed a 1,000 decrease in transportation jobs, following pretty large gains in the past 2 months. Now, the 210s inversion once again turned the conversation to a potential recession. Now, let's look at this. Type in US 10Y, right? And then we want to hit the minus sign right there. And then we type in US 02Y, and that gets us our 210 yield, and whether it's showing an inversion or not. And right now, it's inverted 0.076%, right? When you see the negative or minus sign right here on the chart, this is showing you that it is inverted, right? Because we took the 10-year, we subtracted out the 2-year, and we've got an upside down number, right? So right now, we're living in the upside down 0.076%. And I hope we don't stay in the upside down for too long, because there are some scary creatures down here that I hope we don't run into. Sorry for the Stranger Things mention there, but yeah, how long are we going to be stuck in the upside down? Hopefully it's not too long, because again, you see it in all the headlines. It's a precursor to a recession. But remember, back in 2019, it didn't happen, and that's because the Fed stepped in, threw money into the market, and caused the markets to inflate. And there we go with inflation, because the money printer went brr, right? Okay, you get my point with all of this. Now, this could cause the Fed to become way more aggressive, hiking rates. And if the Fed is aggressive in hiking rates into slower growth, that's not a good sign, okay? And that's why right now, if a recession were to hit, the Fed doesn't have much that it can do. Now, the 210s inversion once again turned the conversation to a potential recession caused by Fed aggressively, caused by the Fed, there's only one, caused by the Fed aggressively hiking rates into slower growth. And to back up that slower growth claim, which we can look at the March ISM manufacturing index. The blue line is the ISM manufacturing index. Now, it was released today for March, and it decreased to 57.1. And you can see that right here, 57.1, and that was down 2.56%. Okay, it's not as low as it was in April of 2020. Actually, April 1st of 2020, that was a low of 41.7. So we're not that low. And that was, again, right after COVID hit, and the market just sunk right after that. So, I don't think we're going to get that low. But if we come down to a 50 or a 49, that's when we're getting into some real scary territory here on the chart. Because if I put a line right here at the 50 mark, okay, 49.99, close enough to 50 there, you can see that we rarely ever get that low. The ISM Manufacturing Index report showed activity slowed to its lowest pace since the end of 2020, while prices continued increasing, which suggests that inflation will continue running at a hotter pace in the near term, which again points to a more hawkish Fed because they want to combat inflation. Now, a positive in the market today was in energy. Oil prices dropped another 0.9% today to $99.54 a barrel. Now, on the chart here, we've got crude oil, and that was down 1.73% today to $98.53. So it's been declining since this high right here on March 24th. And then again, the high here on March the 8th. And if we draw a line on these two peaks, you can see we're starting to make a downtrend now, right? So that's good. If oil does happen to come back up for headline reasons, because that's typically what's been moving the markets the past couple of months since the Russia incursion into Ukraine, then maybe we see oil prices come back up, and it'll be interesting to see if it does touch this line, and then we can mark that as a third point of contact in a declining energy space, right, for oil. Now, oil prices were pressured by news that other IEA nations like Europe, Canada, Mexico, Japan, and South Korea will join the U.S. in releasing oil from their reserves. Now, WTI crude ended the week lower by 12.6%. All right, here's some stocks that were making some waves today, and that was the Chinese EV companies. They reported delivery numbers. First up is NIO, ticker symbol NIO. NIO delivered 9,985 vehicles in March, representing an increase of 37.6% year over year. All right, next up is XPENG. Ticker symbol is XPEV. XPENG reported 34,561 vehicles delivered in Q1 2022, an increase of 159% year over year. Next up is Li Auto, and the ticker symbol is LI for Li Auto. They reported March deliveries with an increase of 125.2% year over year. So here's the answer to the question, what do the markets do when the Fed gets more hawkish? Well, the answer was simple, and I hope this is what you wrote in the comments. The markets go down because the Fed, when it's hawkish, is taking money out of the market. And when the Fed is dovish, when the Fed is doing quantitative easing, the Fed is putting money into the markets, then markets go up. If you could, this would be a great big help. Smash that like button, share this video, and click the first link in the description because I want you to beat the market with us. And if it's your first time watching, click subscribe. For Ticker Time News, I'm Adam. Thank you so very much for watching, and I'll see you in the next video.